A pretty big event in markets today as the yield curve continues to uninvert. 10s to 2s look like they're going next. Quick reminder from yesterday, the red light is back on stocks. It's been on crypto, yellow for bonds and the dollar. But boy, do bonds look like that's going to have to go green any moment. We haven't broken down through the low in the 10-year yield that's held, but that pattern of pressure downward on yields, trying to hold the floor, looks like one that's more likely to break down than up. But that still is very much to be determined by the numbers we'll get over the next 2 days. Big couple days for numbers. Coin flip odds of 50 basis points right now. Markets unable to rally stocks around increasing odds of 50 basis points tells you how serious it is. All the things we've been talking about for months really coming to a head here. The charts and the logic and the fundamentals, namely that bad data are not good for stocks. We don't want to be rooting for a situation in which we have to go 50. That should be quite obvious at this point, with the NASDAQ flailing on the back of weaker NVIDIA trades and the S&P now after breaking the range to the downside. The onus is on bulls the next 2 days to get a better narrative going, because the bond market narrative here is not a good one. And I worry that folks are once again misinterpreting the yield curve stuff. Okay, folks basically saying that because there wasn't a technical recession in that long period of time we were inverted, that it doesn't work. That's not the way this works. We've talked to Campbell Harvey 100 times, it feels like. So I think I can give you a pretty good description of what his analysis and the proper yield curve academics show. Firstly, look at the near-term chart. You can see the 10s to 2s starting to uninvert at zero. Here's the first thing. Campbell Harvey's study looks at the 10-year to the 3-month, which is still deeply inverted. That's number one. But let's just go with the 10s to the 2s for a sec, because that's kind of become the shorthand that everybody uses. Here's the catch. When you are uninverting by way of a bull steepener, which is what's happening as yields drop, that is actually when you start to see the recession brewing. The yield curve going into inversion tells you that you're in late cycle. The yield curve uninverting tells you that you are in cycle. More on that in a sec. One statistic that's very important is that the average time in the recession and yield curve history between yield curve inversion and recession hitting is 11 months. Guess what we're at right now since the yield curve inverted? As you can see on the chart there, the white line 10s to 2s going through zero in the spring of 2022. Okay, we are now, if you break through, basically right at that mark of the average time from inversion to recession. So we're basically at the average. In fact, one of the longest lead times was 2 years, and that was the one before the great financial crisis. Now if you zoom out, so number one is that we're still within the time frame at which the recession would live up to the yield curve standards. The other is that if you look at Campbell's chart here, which I pulled from his dissertation or presentation from it back in the day, you can clearly see when the yield curve uninverts for the last basically 4 out of 5, it gets a little messy in the 80s, but it's very clear. In the last 3 recessions, the yield curve uninverts and then the recession starts. The gray line is the recession. The red line is the yield curve. The yield curve uninverts as the recession's happening underneath, and then it happens. So like people are joking, okay, well, if you got bared up on the inverted yield curve, that didn't work. And now this will fail too. It's just way too ambitious of a logic to assume that this time is different. Give it some space to breathe. We're still within the window that other recessions have been within, with the longest lead time being that almost 2-year lead time from inversion to the GFC. So it's not a good thing when the yield curve is uninverting because the Fed is cutting. We very much are still within the paradigm that Campbell Harvey studied. And that means that if you want to mock the yield curve, do it at your own risk. Have a great night.